Now let's hear from Michael Lewis. He's Managing Director and Global Head of Commodities Research at Deutsche Bank. Thank you so much for coming on the show, Michael. In terms of gold, I mean, it seems at the moment that it can really do no wrong, and yet you speak to investors. Mr. Soros got out of gold in the first quarter, and a lot of investors are still concerned that this is a bubble and that it's just waiting to burst. But you don't agree. You see the price going, what, to $2,000?
That's right. I think there is naturally a concern. The gold price seems to go up when the dollar's falling. It goes up when the dollar's rising. People buy it on inflation protection. They buy it on deflation protection. So it's almost any economic environment, this commodity seems to go up. I think the environment for us is negative real interest rates, a weak dollar, very skittish equity markets. All of these are very, very favourable to it. I think it's still going to go up. I think the bubble number is beyond 2,000, so we do have probably another 20 to 30% to go. When
will it actually reach 2,000? Because in terms of low interest rates, still inflationary pressures, this is going to be with us for a while. So is it in the middle of next year or even afterwards?
Well, I think the sense for us is that we've had a $2,000 target or just above that really since the beginning of this year, and we expect that sometime in 2012. But clearly what we've seen from the Federal Reserve is that its expectations of when it's going to raise interest rates keep getting pushed out, and I think that sustains this, what is the longest gold price rally in history.
But the gold price rally, it has nothing to do with fundamentals, because you also have investors saying, well, it is also linked to fundamentals because there's so much demand for jewelry coming in from the Asian markets. But how much is it linked to fundamentals? 20% or not even that?
Well, I think it's a huge amount due to fundamentals in a sense of financial fundamentals, not so much physical supply and demand. This commodity does not run on the normal dynamics and mechanics of traditional commodities, which look very much at inventory. This is very much driven by very low interest rates. So really all the forces that drove gold down in the 1990s have all moved into reverse over the last 10 years. The danger is that 40% of this market in terms of total demand is investor. And this is where clearly there is a speculative element more than any other commodity, where investors are taking physical ownership of a commodity. This does distort this commodity, and naturally what we're seeing is the relationship of gold to the US dollar has changed, primarily I think because of this investor participation.
Michael, is there going to be an event that actually triggers a sharp rise, or are we again going to just creep up towards that 2,000? For example, if the US loses its AAA credit rating, are we going to see a lot more diversification in, for example, Chinese reserves, and will they buy gold?
Well, I think certainly central banks have been a big player. The Europeans now are under a framework where they're selling actually their very large overweight gold holdings, but actually those pace of sales have slowed down, obviously, as gold has gone up, and obviously in Asia we are seeing the diversification there. So central banks have become a very powerful force within this. So it's not just investors, it's the public sector as well that is diversifying.
Michael, in 20 seconds, what about silver? Because this is also rising, but it's not the same story at all.
Well, silver had a great run. It substantially outperformed gold, and that, I think the danger for it now, and those ISM numbers yesterday, if that ISM number keeps remaining weak and falling, that is a very bad environment. Silver will still go up, but its outperformance with gold, I think, is running out of steam.
All right, Michael, thank you so much. Now